Hello and welcome to another episode of Financial Festivities hosted by yours truly, Grant Preves. Today is October 11th, 2021. Today is Columbus Day. Today we're going to be talking about the importance of retirement savings. We're going to kind of highlight three main points. The first of which is just understanding that retirement is important and why saving early is vital. The second of which is the benefits of utilizing special retirement accounts to either defer taxes, income taxes until you're retired, or pay the taxes initially and allow your earnings to grow tax free. And then finally, I'll give you guys some tools on where to actually invest the funds you're saving, because you can't just save money. You're going to have to invest the money and see gains if you're going to actually be able to retire someday. But before we get into any of that, as usual, we're going to do a quick little market update and see how US equities have been performing over the past week. So again, today is October 11th, 2021. Although it is Columbus Day, the market was open today. The Dow closed at 34,496.06 points, putting it up 1.35% on the week. The NASDAQ Composite also did well. It closed at 14,486.2 points, putting it up 1.21% on the week. And finally, the S&P 500 closed at 4,361.19 points, putting it up 1.19% on the week. And before we get into everything, again, I need to mention I'm not a financial expert. This is not financial advice. This is just simply my opinion. And yeah. So, for starters, retirement is extremely important. It's something that all Americans need to start planning, relatively early in their lives and be looking, it's something they need to get ahead of because it's a major part of life and it requires a lot of money. However, despite the importance of retirement, many Americans just either don't take it seriously or just don't understand the importance of it. According to the Department of Labor, only 40% of Americans have calculated the necessary funds they will need to save for retirement. The average American spends at least 20 years in retirement or over a quarter of their lives. That kind of just shows you the importance of retirement and why it's important to start saving now, because you're going to need money for 20 plus years. So that's quite a long time, which equals quite a lot of money. And finally, also according to the Department of Labor, the average American needs 70 to 90% of their pre-retirement income during retirement a year to, enjoy the same standard of life. So for example, if while you're working, you make 100K a year, when you retire, you're going to want to have 70 to 90K saved a year for retirement in order to kind of enjoy that same lifestyle you had before you were retired. Now that we've kind of explained why retirement is early, I'm going to get into why saving early is extremely vital. This is because of something known as compound interest. For those of you who don't know what compound interest is, it's simply just a term that refers to one producing gains, not just on the initial principal they put into the investment, but also on the interest that accumulates over time. So you're not only making money on what you put in, you're also making money on what you earn through interest over time. And this is extremely important because with compound interest, you see, exponential growth over the long term, which kind of speaks to why getting in early is extremely important. I got kind of a fun little stat here that kind of reflects the importance of compound interest. So with the parameters of $6,000 contributions a year, which is the cap for IRAs, which we'll get to in just a little bit, and assuming a 7% gain a year in the account, which is the average return of the S&P 500, over 25 years with those parameters, you'd expect to accumulate $379,494, which is nothing to laugh at. That's quite a lot of money. However, if you save for just 10 more years, for 35 years, with the same parameters, you'd have $829,421. So just by saving for only 10 more years, you'd overly double your earnings. So that reflects the importance of compound interest and saving early. So you need to start saving extremely earlier. The earlier, the better. All right, now that we've established that retirement is important and saving early is important, now I'm going to kind of give you guys a few details on some of the retirement accounts that will let you, add to your earnings and make even more money through, tax deferring or paying tax and letting your earnings grow tax free. So the first of these accounts is called an individual retirement account. You guys may have heard it abbreviated as an IRA. There are two types of IRAs, a traditional IRA and a Roth IRA. There's one main difference between the two. Well, there's several differences, but the most important probably is that traditional IRA, the taxes are deferred, so you don't have to pay the initial taxes on your contributions. But once you withdraw your funds for retirement, you have to pay the taxes. So let's say you put $500 into your traditional IRA. That $500 is taking out of your income, so you don't have to pay as much in income taxes for that year. But once you retire and eventually start withdrawing these funds you've saved, that's when you pay the taxes. And then Roth IRA is quite the opposite. You pay the taxes initially on the contributions, but then they're allowed to grow tax free, and then you don't have to pay the taxes on them once they're withdrawn. So if you put that same $500 in, that $500 is still considered part of your income, and you have to pay federal income taxes on that. But again, you don't have to pay the taxes on it once it's taken out for retirement. So the contribution limits for both accounts, for both traditional and Roth IRAs, individuals are only allowed to contribute $6,000 a year, which is what I was just talking about for that hypothetical example for the compound interest. But once you turn 50, you're allowed to start contributing $7,000 a year, so a $1,000 increase. However, with Roth IRAs, there is an income limit. So for individuals who file their taxes, individually on their own, once you make 140K a year or more, you phase out of a Roth IRA and are not allowed to use one. You have to use a traditional IRA. And also for people who are married and file jointly, 208K is the max. So if a married couple makes more than that a year, they also have to face to a traditional IRA. Traditional IRA has no income limits, obviously. And then again, the contribution is the same, 6K a year or 7K a year once you're 50. So the main, I guess they say that you would probably want to use a Roth IRA when you expect to be in a higher tax bracket when you retire. This is because with the Roth IRA, you pay taxes on it initially. So if you're paying taxes initially on your income, and you expect to be in a lower tax bracket now than you will be in the future, you're going to save a little money. And then traditional IRA is the opposite again. You would most likely want to use traditional IRA if you expect to be in a lower tax bracket when you retire, and thus why you'd want to defer the taxes until the time that you have to pay less in income taxes. Now, along with IRAs, there's another type of a retirement account through your employer known as a 401k. I'm sure many of you guys have at least heard the term 401k. Even if you don't know its finer details, but that's what I'm here for. So just like IRAs, 401ks are special accounts that let Americans save for retirement. Just like an IRA, there are Roth 401ks and traditional 401ks. The only difference between the Roth 401k and the Roth IRA is there are no income limits on Roth 401ks. So you can make as much as you want a year and still use a Roth 401k if you want. And then just like the IRAs for the Roth 401k, your savings are taxed initially, but then allowed to grow tax free. And then with the traditional 401k, your taxes get to be deferred, but then you have to pay the taxes once you take the funds out for retirement. Another slight difference is on the cap for contributions a year to Roth 401ks. For individual Americans in 2021, you are allowed to contribute $19,500 a year or $26,000 if you're over 50. In total, contributions for your 401k cannot surpass $58,000 or $64,500 if you're over 50, or just 100 or more than 100% of your wage. So whichever one is less, you obviously can't contribute more to your 401k than you make in a year. And then there's another exception for 401ks for people who make a lot of money, like a lot of money. They're known as highly compensated employees. So there's two criterion that you only have to meet one of them to be considered a highly compensated employee. The first of which is if you make 130K or more a year, um, your caps is going to be different. It's not the $19,500. And then if you own more than 5% of interest in the business, or in a business, you're also considered a highly compensated employee, and therefore a different contribution limit applies to you. So it's not extremely specific, but for these highly compensated individuals, their 401k contribution limits are limited to only 2% more than the average employee at their company contributes to their 401k. So let's say a highly compensated individual works at a company and the average employee who is not highly compensated contributes 5% of their wage to their 401k, then the highly compensated individuals would not be allowed to put any more than 7% of their wages into their 401k, which is 2% more than 5%. So that's kind of another weird rule. Again, it doesn't apply to most people, only people who make quite a bit of money. So those are the details for both 401ks and IRAs. Something I actually did forget to mention about 401k accounts is some employers do a matching program where up to a certain amount, the employer will match what you put in your 401k. So that's where that upper bound of the $58,000 comes from. Some of you guys might have been wondering, well, if you can only contribute $19,500 a year if you're under 50, why would you ever be able to put in more than $58,000? Well, that includes total contributions, including from your employer. So you and your employer combined cannot put in more than $58,000 a year into your 401k if you're under 50, or 100% of your wages, as we talked about. So now that we've talked about special retirement accounts and as well as clarifying the importance of retirement, I'm going to kind of give you guys what I think is one of the best ways, the most conservative, smart, and easy ways to save for retirement. The first thing I would recommend is when you're investing in money that you're going to be putting into retirement accounts, do not pick individual stocks. I know there's probably many self-proclaimed stock experts out there who think they can consistently pick winning stocks over the long term. However, this is just not the case. According to a study done by Standard & Poor Global, it's a study they do every single year where they compare domestic fund managers to their respective indices. In 2020, 86% of domestic fund managers failed to beat their respective indices or stock indices. In layman's terms, that basically means the majority of professional stock pickers failed at their job. So logic kind of begs the point that if professionals can't even pick stocks for a living, then how on earth is a typical American, like me or you, going to be able to pick stocks? Sure, you might get lucky every once in a while and pick a stock that does well, but there's no way for 40 years you're going to be able to consistently pick stocks that perform well. So what I recommend you do is invest in index funds or invest in mutual funds that largely invest in index funds. One of these types of mutual funds that I'm a huge fan of that I will recommend to you guys are something known as target date funds. Now, target date funds are a specific type of mutual fund that companies or mutual fund companies put together that have a target date as the title kind of infers, and that date aligns with the year you want to retire. So, for example, for someone like me or for a student who's listening to this podcast right now, I probably would enjoy retiring in around 40 to 45 years. Well, I'd actually probably enjoy retiring tomorrow, but considering I don't have a job yet, I think that might be unrealistic. But all jokes aside, I'll probably end up retiring around 2065. And there's a target date fund for that. there's target date funds for every single year in increments of 5. So like there's a target date fund for 2025, 2030, all the way up to, 2065, which is what I will probably invest in. And the cool thing about target date funds is it automatically adjusts the allocation of assets as one gets closer to retirement. So, for example, I'm looking at the Vanguard target funds. Vanguard is a great company. It has extremely low expense ratios, which we'll get to in just a little bit. So for the Vanguard 2025 target fund, so this is what people would invest in who want to retire in 2025. So in 4 years, it's pretty soon. If I look at the allocation of the funds, only let me look. Only about 50% of the fund is allocated towards stocks, and it's allocated in stock indices. So it's not specific stocks, they're just simply market averages. And the rest of the fund is in bonds. So that's relatively conservative because the retirement's coming up soon. So bonds are, a more conservative investment than stocks, because even though there's no investment that's completely risk-free, bonds do certainly guarantee income, on more so than stocks, but it's not 100%, but it's considered way safer than stocks. But if you look at the 2065 fund, which is way farther out in the future, which someone like me might use, the funds are way more aggressive. So you're going to have, let's see, about over 90%, about 93%, 93% of the fund is in stocks, and only about 8 to 9% are in bonds. So that kind of shows you the difference between a fund that's out far in the future and the fund that's relatively up close. And then for that 2065 fund, as we get closer to the target date of 2065, the funds will start to move away from more aggressive investments like stocks, and then put them into more secure investments like bonds. Because as you get closer to retirement, you don't kind of want to be victim to the woes of the stock market. So for example, if like you were about to retire and COVID hit and the stock market went down, 30 to 50%, you don't want to lose half of your savings. So that's why they start putting more in bonds, because it's more of just a safe proof against things like that, because nothing's guaranteed in the stock market. And then the last thing I'm going to say about target date funds is there's all sorts of different companies that make these target dates funds. There's Vanguard, which I've been talking about. There's Fidelity. There's Charles Schwab. There's T. Rowe Price. There's a bunch of great companies out there. I'm not going to tell you a specific company to use. That's up to you. That's personal preference. But what I would specifically look at, or what would probably be the primary factor in choosing target date funds, is expense ratio. And that's something I mentioned earlier. The thing about the stock market is, although you can look at the history of gains of these funds, nothing is guaranteed. So, past results don't, or past, performance, it does not guarantee future, outcomes. So what I would just simply do is find a target fund that has an extremely low interest or expense ratio. For example, the Vanguard 2065 target fund has an expense ratio of 0.15%. And what an expense ratio is, it essentially tells you what percent of the fund's assets is going to be used to cover, costs like, paying the employees who work at, Vanguard, who put together the fund. So typically an expense ratio between really anything under 1%, 0.75 to 1% is good. This 2065 fund is 0.15%, which is extremely good. So I used a calculator that calculates the total expenses I will lose from something like the Vanguard 2065 fund. So with $0 initially invested and contributions of $6,000 a year, which is the IRA, and then for 40 years, and a rate of return of 7%, which I just figured, let's do the market average of around 7%. After 40 years, I'd have about $1.2 million. But I would lose $50,000 to fees. So although the expense ratio might not seem like a big deal, like, oh, it's only less than 1%, that can't mean anything. Even with a expense ratio of only 0.15%, I'm still going to be losing $50,000 over my lifetime, which is quite a significant amount of money. So that's why I think expense ratios are important. And the most important thing when looking at picking a fund, you can look at past performance of funds the company has managed, but I'd honestly just look at lowest expense ratios because that's the one thing you can't guarantee. You can't guarantee you'll be losing money with expense ratios, so you may as well lose as little money as possible. You can't guarantee you'll make money. So I think expense ratios are the number one factor to look at. And with that being said, I'm going to close with a quote from Warren Buffett. Warren Buffett, as you know, I respect dearly. He's probably one of the most brilliant investors of our lifetime. In this quote, he's kind of just giving credence to the idea of investing in stock indices and why one probably most likely wants to avoid individual stock picking. So he said, quote, "The 21st century will witness further gains, almost certain to be substantial. The goal of the non-professional, like you or me, should not be to pick winners. Neither he nor his quote helpers can do that, but should rather be to own a cross section of businesses that in aggregate are bound to do well, like an index fund. A low cost S&P 500 index fund will achieve this goal." So essentially, he's kind of saying what I was saying. If you're not a professional, or even if you are professional, uh, it's extremely hard to beat the average, which is the stock indices. So you may as well just invest in the stock indices for the long term, because that's the closest you'll get to, substantial growth over the long term. So I think that's kind of it for this episode. Again, retirement is extremely important. I don't want to freak any of you guys out. You still have plenty of your life ahead of you. You have time to, plan and get everything figured out. I would most certainly not freak out about saving for retirement if you don't even have a job yet, or if you haven't even gone to college or anything like that. I think I'd start saving for retirement and really getting those things sorted out once you kind of are settled into your, first career job and you have, access to, 401k accounts for your employees. But if you're just in high school or in college right now, I would not worry about saving your money and putting them in retirement accounts, because once you're in like accounts like IRAs and 401ks, there are penalties for taking that money out early. So before you actually are in a career and have a job, I would just say keep your money out of those special accounts because again, there are penalties for taking them out. So that's going to be it. Thank you guys for listening and see you on the next one.